Do you know you can find four different type of profit margin just by looking at the income statement. For example, take the statement where we have started with sales, deducted cost of goods sold and arrived at gross profit, deducted operating expenses and arrived at operating profit, deducted non-operating expenses, so we have profit before tax, then taxes are factored, we have profit after tax. By looking at this statement itself, we can find out four different type of profit margin. Yes, by comparing the gross profit with sales, that is 50 over 100, I can find out what is gross profit margin, which is 50%. So this is the gross profit margin. And this communicates whether this business is selling the goods at a price higher than at the price they have purchased or not. So here the cost of goods sold is 50, they have sold for 100. It means this business is generating a gross profit of 50. It means it is 50%. Then I can also find out what is known as operating profit margin. For that, what I can do is I can compare the operating profit with sales. That is 20 divided by 100 into 100 will give me operating profit margin of 20%. It means they have made sales of 100, but they had various expenses, that is cost of goods sold and operating expenses all put together. After that, whatever the profit what they have earned translates to 20%. And this profit is very important because this is the profit they are making from their operations. Okay, then I can also compare the profit before tax with sales, that is this 15 can be compared with this 100. So 15 on 100, it will translate to 15%. So this is the profit this business has made before paying taxes, and I can compare the profit after tax with sales, that is 10 over 100 into 100, which will translate to 10%. And this communicates that eventually this business is making 10 percentage profit margin on every sale for its owners. So four different type of profit margins just by looking at income statement.